Okay, let's dive right in. We're going to talk about one of the biggest, most exciting shifts happening in Indian finance today, the incredible rise of alternative investments. Seriously, this is a revolution that's completely reshaping how people build wealth.
For the longest time, that was the go-to answer. But for a whole new generation of investors, that answer is a big, resounding no. And that's opening up a whole new universe of opportunities way beyond the usual stock marketplace.
Just look at this number, 100 lakh crore. Let that sink in. That's the forecast for India's alternative investment fund market by 2030. That's a five-fold explosion in just 6 years. This isn't just a trend, it's a seismic shift.
So, what are these alternatives everyone's talking about? Well, think of them as investments that kind of march to the beat of their own drum. They don't just go up and down with the Nifty 50. And that separation is absolutely key to diversifying your risk. These are usually managed in something called alternative investment funds, or AIFs, and we're going to hear that term a lot.
All right, let's get into the fun stuff. We're going to start with two really innovative options that are taking these super complex assets and making them available to way more people. This is where finance gets really creative.
So, imagine this. You could lend money against a company's unpaid bills owed by a big, reliable company. And then you get paid back with interest. That, in a nutshell, is invoice discounting. You're basically buying short-term debt that's got a pretty solid promise of being paid.
And the process itself is surprisingly simple, all handled online. It's a total win-win. A business gets cash right when they need it, and you, the investor, get a short-term investment that can turn a profit in just 1 to 3 months. Pretty cool, right?
And this is where it gets really compelling. Just look at the potential returns here. We're talking 12 to 20% a year. When you compare that to a traditional fixed deposit that might get you, 7 or 8% on a good day, you can see why people are getting so excited.
Now let's pivot to property. Who wouldn't want to own a piece of a prime office building? But for most of us, that's just not possible. Well, fractional investing changes the game. It lets you own a slice, giving you all the benefits of property ownership without needing crores in the bank.
This model basically solves the two biggest headaches of real estate, the crazy high cost and the absolute pain of being a landlord. You get to collect your share of the rent and benefit from the property's value going up, all while a team of pros handles everything from finding the property to dealing with the paperwork. It's real estate investing, just without the drama.
Okay, next up, let's see how this trend is even breathing new life into some classic assets. We're going to look at a timeless investment, gold, and then dive into a really powerful new force in the world of business finance, private credit.
Yeah, even something as ancient as gold is getting a modern makeover. Of course, physical gold has that tangible security. You can hold it in your hand. But digital gold, it's all about convenience. You can buy tiny amounts online with just a click, and you never have to worry about storage or security. It really just depends on what you're looking for.
Now this one is a really big deal. As our traditional banks have become a bit more careful, maybe a little slower to lend because of past issues, a whole new class of lenders has jumped in. Private credit is basically investment funds lending money directly to businesses. It's a huge and growing investment category.
So what's the real difference? In a word, agility. Private credit can offer flexible, customized loans, and they can do it fast. For businesses that don't quite fit the rigid boxes of a traditional bank, this kind of nimble capital is an absolute game changer.
So with all this money pouring in and all this crazy growth, you might be thinking, is this the Wild West of finance? A little bit risky? Well, not so fast. Regulators are definitely paying attention and stepping in to make sure this market grows up the right way. See, regulators like SEBI started to notice that some funds were getting a little too creative with the rules. They were worried about stuff like evergreening, which is basically a sneaky way to hide bad loans by just issuing new loans to pay off the old ones. And they were also concerned about funds being used to get around other financial regulations.
So to tackle this, SEBI rolled out a new requirement called specific due diligence. It basically forces fund managers to be much more careful and to check exactly where the money is coming from and where it's going. It's all about shutting down those backdoors and making sure these funds aren't being used to bend the rules.
Now, the goal here isn't to stop the growth. It's to make sure the growth is healthy and sustainable. By cracking down on these tricky practices, the aim is to build a much more transparent and trustworthy market. It's all about making sure this new wave of finance is built on a rock-solid foundation.
Okay, so we've covered a ton of ground. The massive growth, the cool new products, the new rules of the game. So what does all this actually mean for you? the investor. Let's put it all together. This little table breaks it down nicely. You can see the trade-offs really clearly. Invoice discounting? Yeah, you get those high returns, but you have to be mindful of the risk that the vendor might not pay. Fractional real estate is great for long-term income, but you can't just sell it tomorrow. It's illiquid. Every single one of these has a specific job to do and its own risk profile.
So when you step back and look at the whole picture, one thing becomes incredibly clear. Alternative investments are no longer some niche, secret product just for the super rich. They are going mainstream, and they're becoming a key part of how everyday people create wealth. This isn't a fad, it's the future.
And that really brings us to the final, most important question. And this one's for you to think about. As these powerful tools become safer and easier to access, the question really isn't if you should be paying attention to them anymore. The real question is, what role are they going to play in your wealth strategy?